Welcome to the deep dive. Look, if you're an everyday investor and you're watching your portfolio just bleed red today, it's really easy to panic.
Oh, absolutely, yeah.
But today we're looking at this stack of SEC filings, some federal proposals, market data, basically to unpack this massive contradiction happening right under our noses.
Yeah, we are seeing this really stark structural dichotomy right now. On one side, you have, intense short-term price suppression.
Right.
But simultaneously, you've got players like the world's largest aerospace company and the U.S. Federal Reserve just quietly cementing permanent infrastructure for the asset class.
So our mission today is to figure out what is actually going on beneath the surface.
Yeah.
And let's just start with the immediate pain, right? The liquidity squeeze, because the charts have just looked brutal.
They really have, yeah.
We saw the spot valuation test this extreme low of, I think, 76,892 tuitrins before it sort of consolidated near 77,200.
Right, and that compression it's really being driven by massive ETF capitulation. I mean, over $331 million exited U.S. spot ETFs on Tuesday alone.
Wow. Tuesday alone.
Just Tuesday. Traditional allocators are looking at the broader macro environment, specifically, high-yield sovereign debt, and they are just systematically unwinding their spot exposure.
It kind of feels like watching Wall Street treat Bitcoin like a financial shock absorber.
Yeah.
The second U.S. Treasuries offer a safer yield, they just wring out the sponge and move their cash.
Exactly.
But I mean, is this a total retreat from the space, or is it just like a sector rotation?
It's absolutely a rotation. Macro funds treat the primary reserve asset strictly as a duration proxy, like that shock absorber you just mentioned.
Right.
But aggressive venture capital isn't leaving. They're actually rotating into high beta application layer protocols that have, native yield mechanics.
Okay, hold on.
Yeah.
Unpack that for me, because high beta application layer protocols with native yield mechanics that's a mouthful.
Fair enough, yeah. It simply means they aren't leaving crypto. They're just moving their money from basic Bitcoin into crypto apps that actually pay them interest.
Oh, okay. So like moving capital from a static gold bar into, say, a high-yield savings account.
Exactly. Or like a tech stock that pays consistent dividends. Take Hyperliquid, for example. While the primary ETFs bled their native token HYPE, it actually saw a $25.5 million single-day inflow.
So Wall Street is basically treating the asset like a short-term trade, just dumping it when yields shift. But if we look away from the hedge funds and look at the actual builders, like the tech and aerospace giants.
Oh, they are actively taking advantage of this price drop to hoard the asset permanently.
Yeah, like SpaceX, their S1 filing just revealed a massive treasury, what was it, 18,712 Bitcoin?
Yep, roughly $1.45 billion. And at the exact same time, Tether acquired SoftBank's stake in 21 Capital.
Which holds over 43,000 Bitcoin, right?
Right. To forge this vertically integrated mining and payments conglomerate.
I got to push back here, though. I mean, isn't an aerospace conglomerate holding over $1 billion in crypto just a massive distraction?
It sounds like one.
But they're supposed to be building rockets, right? Not running a hedge fund.
Well, it sounds like a distraction until you actually look at the dual asset architecture model they're deploying.
Okay, wait. Dual asset architecture sounds great in a boardroom, but what does that actually mean for a company trying to get to Mars?
It means they use physical engineering to generate revenue, but they store that treasury in a mathematically scarce digital asset, to protect it from inflation.
Oh, wow. Okay.
And the decentralized pre-IPO markets actually rewarded this. On Hyperliquid, futures contracts tracking SpaceX's future equity spiked. They priced the company at a staggering $2.5 trillion implied valuation.
So they're effectively front-running the legacy Wall Street underwriters.
Completely.
So this massive corporate entrenchment, it's essentially forcing the federal plumbing to finally adapt. Because if the biggest companies on Earth are holding billions on chain, the government can't just ignore it.
Precisely. Which brings us to the Fed. They just proposed these special payment accounts, granting crypto firms direct access to the FedWire settlement network.
But with a massive financial straitjacket, right?
Oh, absolutely.
Because these accounts are strictly pre-funded, they yield zero interest, and the balances are capped at $1 billion. And concurrently, you have the Parity Act proposing to close the crypto wash sale loophole.
Right, while exempting everyday stablecoin transactions from capital gains friction.
Exactly. So how is the Fed rationalizing all of this?
Honestly, it's a masterclass in risk mitigation. They are granting this necessary sovereign settlement access so these firms can finally bypass the commercial bank monopolies.
Okay.
But by forcing these crypto firms to pre-fund their accounts, They completely change the risk profile.
Because they have to deposit the cash before they can move a single cent.
You've got it.
Yeah.
The Fed ensures it never accidentally loans them a dime. So no loans means zero credit risk for the central bank.
And zero risk for the taxpayer.
Exactly, while still, modernizing the plumbing.
So for you listening, watching those red charts today,
Yeah.
the immediate market pricing is totally captive to these algorithmic distributions. Wall Street is just playing a short-term yield game.
But the legislative and corporate integrations happening right underneath, those are basically irreversible. The concrete is poured.
Which leaves you with this provocative thought to chew on. If decentralized, crypto-native matching engines possess the liquidity to accurately price SpaceX's massive equity debut before legacy markets even open,
Right.
what happens to traditional investment banks when the world's biggest IPOs start launching entirely on-chain?